Welcome. Today we are going to discuss about what are venture capital funds. So without further ado, let's dive straight into it. It is a pool of money collected from 99 number of investors who are also called as limited partners or LPs, and a person who manages that fund, that pool of money, is called as general partner, who has a team below him to manage that money. And venture capital primarily invests in startups, early stage startups or late stage startups. Based on that, there are different types of venture capital funds, which we will discuss in later part of video. Before moving forward, there is a disclaimer that my knowledge is limited and the information which I share is based on my current understanding and learning. So I can be wrong at times, and I welcome open discussions and corrections in the comments below. So first of all, what is a early stage venture capital fund or late stage venture capital fund? So the name itself suggests that early stages they will invest in startups which are small in size and which are early in their journey. And late stage venture capital funds will invest in later stages of the startups when it is becoming mature company. So now we'll take an example of a early stage startup. So let's take an example of a VC fund who is managing 100 crores. These are typically called as micro VC funds because they are small in size. So they will invest in, let's say, 50 companies. So average they will invest 2 crore in one company. So if they invest in 50 companies, their aim is 40 companies might fail. Just 10 companies will return their entire capital, majority of the capital, 80-90% of the capital, and also the return. And these are very high risk, high return investments. So there is a Pareto principle or power law which says that like 20% companies will return 80% of the capital and 80% of the companies might return even less than 20% of the capital. So out of the 50 companies, only 10 will return majority 80% of the money back, and 20% of the money will be returned by the 80% of the companies. Most of them will fail. So in our example, 10 companies and 40 companies. So 10 will return majority money and 40 will fail or return very low amount of money. Now how these things works. So basically a startup is there who is uh, having a little bit revenue of 5-10 lakhs, and it is going for a seed round of 1 to 2 crores. So the early stage venture capital fund, which is a micro VC fund, will give him that money, and they will take 20% or 15% of the equity of that startup. So as soon as the startup starts growing, that is, they start using that money and starts generating more revenue. So let's say they got 2 crore in funding and they generated 1.8 crore in revenue. Before diving deep into venture capital or how it works, first of all, you need to understand how a startup grows. Like a small startup, which then turns into a bigger company. So, how that whole process actually occurs, that you need to understand first. Then only you can understand venture capital in a easy way. Before moving forward, if you haven't watched the video of how a new age startup grows or scales, then you need to understand that first before understanding venture capital, because then only you will understand venture capital easily. The link of the video is in description, or you can check out in the I button as well. So let's say there is a startup named ABC, which is started by his owner with his own capital of 510 lakh rupees, and it is generating some 510 lakhs in revenue. So now they want to grow, so they need 2 crores. So a venture capital fund invests 2 crores in there, and then they start generating 1.8 to 1.9 crore in revenue, and then they are looking for another bigger growth. So they want to grow to 10 crore in revenue. So again they will look for another venture capital fund who will invest 10 crore in them so that they can grow. So in every round, the first round was 2 crore, second round was 10 crore. So in every round they will typically dilute 15 to 20% of their company. So then second VC will come, then third VC will come. Let's say in the third year, they want to grow from 10 crore in revenue to 50 crores in revenue. So they will need for another 40 crores. So let's say another venture capital fund came, they invested 40 crores, and now the startup is doing 40 crores in revenue, 50 crores in revenue. The earlier 10 and 50. So like this, the startups grows, and the founders will be having maybe 40% of the equity till now. If we say that 20% in first round was diluted, 20 was diluted in second, and in third, so for 60% of the equity, that is the ownership of the company, is diluted to these three VCs, and now 40% is left with the founders. So this is how a startup scales from small to a bigger company. So now there is a scale of VCs, like micro VCs, medium size VCs, then bigger VCs, and then biggest of them like huge late stage VCs, and then private equity funds are even bigger than that. So there is a scale of them. So we'll take some examples. Let's say a VC fund is managing 100 crores, then another VC fund is managing 500 crores, then another bigger than that is managing, let's say, 5,000 crores. So these are three examples of VCs. Every VC will invest typically in 50 companies. Whatever the scale it is, doesn't matter. So that means is the round size, the check size will soon will start rising. Like a small VC fund which was managing 100 crores will typically invest 2 crores average check size in a startup. But on the other hand, the VC fund which is managing 500 crores, they will typically invest 10 crores in every round. Rest of the things we will discuss in part 2 of venture capital, because this video is getting too longer. But before that, I want to tell, first you need to understand how a startup grows. So I would highly recommend you to watch this video first before going deep into venture capital. The link of the video is in description, or you can check out in I button as well. The video on how startups, new age startup scales.